If I had to start investing today from scratch, knowing what I know about this market, the earnings explosion, the AI infrastructure race, and the cracks starting to show beneath the surface, I would not look at new all-time highs the way most people look at them. Most people see stocks making records, and they instantly think, okay, that's it, we're in a bubble, I missed the move, I should wait for the crash. But that's not always how markets work. Sometimes prices run ahead of reality, and sometimes reality catches up faster than people expected. Today is Monday, May 4th, New York time, and I want you to comment what day and date you're watching from, because this market is moving fast, and I want to know where you are watching this story unfold from. And if this kind of research helps you, support the channel by subscribing and comment John AG Best if you value this content. Now, here's the uncomfortable part. The market can be at record highs and still not be in the kind of bubble everyone is screaming about. But that does not mean everything is cheap. That's the mistake. People want one simple answer: bubble or no bubble. Buy everything or sell everything. But this market is not that simple anymore. We are living in a split market. At the top, you have huge companies printing profits, expanding margins, and pouring money into artificial intelligence like they're building the next railroad system. Underneath that, you have consumers getting squeezed, lenders watching credit more carefully, and some sectors quietly telling you that the economy is not as strong as the index makes it look. So in this video, we're going to walk through what's really happening, not the emotional version, not the headline version, the actual setup, earnings, valuations, AI spending, the stocks that could move hard this week, and the risks that investors are pretending not to see. So let's get started. Now, the big question is obvious. Are stocks in a bubble? And my answer is this: parts of the market probably are stretched. Some stocks have already priced in a perfect future. But the whole market is not automatically a bubble just because the index made a new high. Why? Earnings. Based on recently published numbers, S&P 500 companies are reporting profit growth in the high 20s for the first quarter. That is not normal. That is not boring. That is a major reason the market has been able to absorb higher prices without valuations getting completely insane. And that's the part most people miss. A stock price by itself tells you almost nothing. A market level by itself tells you almost nothing. What matters is what you're paying for the profits underneath. If prices rise but earnings rise faster, the market can actually become less stretched than it looks. Now, don't misunderstand me. I'm not saying stocks are dirt cheap. They're not. The forward market multiple is still above its longer-term average. So anyone telling you this is some once-in-a-lifetime bargain across the whole index is probably getting a little too excited. But anyone saying this is exactly like the worst bubble peaks is also skipping the earnings side of the story. The truth sits in the middle. And that's usually where the money is made. Think about the last major valuation scare. The market had run hard. Investors were paying very rich prices for each dollar of earnings. Then rates moved higher, and the whole thing had to reprice. That's how markets punish fantasy. But this time, profits are doing more of the heavy lifting. The rally is not just multiple expansion. It is also earnings expansion. That matters. But here's the catch. The bullish case depends on those earnings continuing. If earnings slow down, if margins roll over, or if the consumer finally breaks, then the whole valuation argument gets weaker very quickly. So the market is not bulletproof, it is earnings proof for now. And this week we get a major test. AMD reports Tuesday, Arista reports Tuesday, Supermicro reports Tuesday, Fortinet and Symbotic report Wednesday, SoundHound reports Thursday. That is a packed week for AI, chips, servers, networking, cybersecurity, warehouse automation, and voice AI. In other words, this is not just an earnings calendar. This is a stress test for the entire AI trade. Let's start with AMD. AMD is one of those companies where the business story can be strong, but the stock can still become difficult. Demand for AI chips is real. Data center spending is real. The market is giving AMD credit for being one of the few names that can even attempt to compete in high-performance AI hardware. But when a stock has already moved aggressively, good news is not always enough. That's the problem with momentum. At a certain point, investors stop asking, did the company do well? They start asking, did the company do better than the dream? That's a much harder test. If AMD gives strong numbers but guidance only sounds normal, the stock can still get hit. Not because the company is broken, because expectations are high. Then there's Arista. Arista is not the loudest AI name, but it sits in one of the most important parts of the AI build-out, networking. Everybody talks about chips, but chips need to communicate. Data centers need speed. AI workloads need massive bandwidth. And if the networking layer fails, the entire machine gets slower. So Arista matters. But again, valuation matters too. A great company can still be a risky stock if investors already paid for 2 years of good news up front. So with Arista, I'd watch the earnings reaction carefully. If the stock drops because growth is slowing, that's one thing. If it drops because expectations were simply too hot, that's another. Those are not the same situation. Now, Supermicro is the wild one. This stock can move like someone strapped a rocket to a roller coaster. The AI server demand story is powerful, but the trust issue is just as important. When rumors, short sellers, guidance questions, and server order concerns all hit at the same time, earnings become more than earnings. They become a credibility event. Management needs to show demand is still there. They need to show the outlook is intact. They need to show that the AI server story is not just hype sitting on thin margins and messy expectations. If they do that, the stock can move hard. If they don't, the market will not be gentle. And then cybersecurity. Fortinet reports Wednesday, and this whole cybersecurity group has been treated strangely by investors. Some people are acting like AI will replace cybersecurity software. Maybe AI changes parts of the workflow. Of course it does. But AI also gives attackers better tools, faster automation, and more ways to probe systems. So the idea that companies will spend less on defense because threats are getting smarter does not make sense to me. The better question is not whether cybersecurity matters. It does. The question is which companies can keep pricing power, grow efficiently, and avoid getting disrupted by new AI-native competitors. That's where Fortinet becomes interesting. Slower growth is not automatically bad if margins are strong and valuation has reset. But if growth slows too much, the market will treat it like a value trap. So this report matters. Symbotic is a different kind of AI story. This is not just cloud servers and chips. This is automation in the real world, warehouses, logistics, retail supply chains, robots moving inventory. That's not as exciting to talk about as the newest AI model, but it may be more practical for many companies trying to cut costs and improve efficiency. The risk is reinvestment. When companies are building for the future, earnings can look messy today. And in a market like this, messy earnings can get punished even if the long-term story is intact. SoundHound is even more speculative. Voice AI and agentic systems could become a much bigger market. But here's where investors need discipline. A big story is not the same as a clean business model. Growth can be exciting, acquisitions can make revenue look bigger, and short squeezes can create violent upside moves. But none of that replaces the need for durable revenue, better margins, and a path to profitability. A short squeeze is not a strategy. It's a firework. Now let's talk about the bigger AI build-out, because this is where the market story gets really important. The hyperscalers are spending unbelievable amounts of money. We are talking about hundreds of billions flowing into data centers, chips, servers, networking, storage, cooling, and power. Meta raised its capital spending outlook. Alphabet has been pushing its own infrastructure spending higher. Amazon is spending heavily around AWS and AI capacity. Microsoft is still investing aggressively because demand is running into capacity limits. This is not a small theme anymore. This is an infrastructure cycle. And that means the winners may not only be the obvious chip names, the money spreads. First it goes to GPUs, then networking, then memory, then storage, then power equipment, then cooling, then construction, then real estate, then utilities. That's how a theme becomes an economy. And from recent market updates, electricity demand is becoming one of the biggest bottlenecks in the AI story. The US power grid was not built for every major tech company to suddenly need giant AI factories. Data centers need stable power. They need backup systems. They need transmission. They need cooling. And communities are starting to push back against new projects because of electricity costs, water use, land use, and noise. That creates a strange opportunity. If demand for data centers keeps rising, but new supply becomes harder to build, existing data center assets become more valuable. That's why data center REITs and digital infrastructure names deserve attention. Not because they are risk-free, but because scarcity can create pricing power. Now energy matters too. Oil has been elevated because of geopolitical tension, especially around Iran and shipping risk. That helps parts of the energy sector, but it also creates pressure for consumers and companies. Higher oil means higher gasoline. Higher gasoline means less money for everything else. And when the consumer is already stretched, energy becomes more than a commodity story. It becomes an economic pressure point. This is where the market's bright surface starts to crack. The consumer is not as strong as the index. Inflation has cooled from the worst levels, but prices did not go back down. That's the part regular people understand better than economists. A lower inflation rate does not mean life got cheap again. It means life is getting expensive more slowly. And the latest CPI data still shows inflation in the low 3% area, with energy and gasoline causing renewed pressure. That matters because consumer spending is the backbone of the US economy. If households pull back, companies feel it. If companies feel it, earnings estimates get questioned. And if earnings estimates get questioned, the market's valuation support gets weaker. Financials are another warning sign. Loan delinquencies are not screaming crisis, but they are not something to ignore either. Credit card stress, auto loan pressure, student loan strain, and higher borrowing costs all tell you the same thing. The lower part of the consumer base is not floating through this economy easily. So when people say, the market is strong, I always ask, which market? Big tech market? Strong. AI infrastructure market? Strong. Consumer pocketbook? Mixed. Credit cycle? Needs watching. Small businesses? Not as easy. Banks and lenders? Careful. That is the real picture. So what do we do with all of this? We don't panic just because stocks are at highs, but we also don't chase everything with a ticker symbol and an AI headline. We stay selective. We watch earnings. We respect valuation. We understand that the market can keep moving higher, but the leadership can rotate underneath. The opportunity over the next decade may not come from guessing the exact top or bottom. It may come from understanding where the spending cycle is real. AI infrastructure is real. Power demand is real. Data center scarcity is real. Cybersecurity threats are real. Automation is real. But not every stock attached to those themes is automatically a winner. That's the difference between a story and an investment. If you're successful, share your success story in the comments so others can stay motivated. And tell me this in the comments. Are you more worried about a stock market bubble, or are you more worried about missing the next leg higher? Because that answer probably tells you more about your portfolio than you realize. My view is simple. This is not a market where you go to sleep and buy everything blindly. It is also not a market where you sit in cash forever waiting for the perfect crash. You build a watch list. You track earnings. You watch margins. You watch guidance. You watch the consumer. You watch jobs. You watch oil. And when the market gives you fear, you ask one question. Did the facts change? Because if the facts did not change, fear may be an opportunity. But if the facts did change, then that dip is not a gift. It is a warning. Subscribe if you want more calm, practical market breakdowns like this, and drop the one stock you're watching most closely this earnings week. And remember, this is for education and perspective only. I'm not your financial advisor. I don't know your risk tolerance, and I'm not telling you what to buy or sell. Use this as research, think independently, and make decisions that fit your own portfolio, your own timeline, and your own life.